So with that said, we will be getting started. My name is Alex Perny. I've been with Advanta since 2012. If you have any questions regarding anything that we are presenting on today, feel free to reach out to me directly afterwards. I am always happy to help, or if you would like a copy of the slides, happy to provide those as well. A little bit about Advanta IRA. Very proud to say that next month we will have been open for a total of 20 years, and we have in that time frame have only serviced alternative assets such as private stock, real estate, and anything that is not a publicly traded stock, bond, or mutual fund. So it's not something that we are just now branching into. We have our basis of expertise in some type of other asset class. This is all we have done since our inception and pretty much all we will continue to do going on in the future. So if you have any questions or you'd like to get more of an understanding on kind of how you can utilize IRA funds to invest in some type of private offering, please don't reach out to us. We have over 9,000 active clients and currently administer over 2.4 billion in assets under administration, which is something that we're very proud of. And if you do have any questions or we need some assistance, we offer dedicated account management to each and every client that has an account with us. And if you're on the side of someone raising capital, that means that your clients and you are always dealing with a single IRA professional on the other end of the line. You're not calling and getting a different person each time we're dealing with whole departments. You get that hands-on structure that is really key to making sure things that are done efficiently and correctly. That is very paramount, and especially investing in something as mission critical as funding for a startup. So just a little bit about Advanta and what we do. So I always like to kind of preface these presentations with giving people a little bit of an overview of kind of who we are and essentially what we do. And it needs to be said that we do have a scope of what we do here at Advanta. Advanta IRA and our employees do not provide investment, legal, or tax advice, nor do we promote or endorse any investment. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of financial investment. Quick question that I'll just address before we get started. What is the maximum amount or percentage you can direct to a specific investment from a self-directed IRA? There is none. If you would like to utilize the entirety of your retirement plan to invest in someone's project or any type of offering, you are certainly welcome to do so. You don't have to have allocation percentages based on asset type. If you have a $100,000 IRA at, let's say, Vanguard or Fidelity, and you want to plug that whole amount of money into a private offering, you are certainly welcome to do so. Okay, a few kind of key takeaways. The types of typical startup investment structures. There are a lot of them out there, and they're not all created equal, and they all offer different types of benefits and just inherently different types of structures that people can utilize. Some of the rules related to IRAs and startup investing, and some of the tax benefits and issues that also people encounter when doing these types of investments, because essentially it's very important to understand not only what benefits are of a particular investment structure, but also what some drawbacks are. There's no such thing as a perfect investment. Maybe winning the lottery, but that's certainly not the case with the normal course of life. So understanding rules, regulations, tax benefits, and what types of options are out there for people are very important. And question someone just asked, could the self-directed IRA also be a Roth IRA? Yes, we'll get into the different types of accounts here in a moment, but certainly they can be. So what is a self-directed retirement account? It's, for lack of a better term, it is a marketing term. But really what we are focusing on, a self-directed retirement plan is something that gives the owner complete control over their retirement funds and investing decisions. You're not just constrained by the stocks, bonds, and mutual funds that you're typically offered at a more traditional wirehouse. So those aren't kind of approved by the IRS per se. It's just what those types of companies will allow for their clients to invest in. Really, so long as that the investments don't violate a few regulations and rules, you're really open to invest in whatever you'd like to, so long as that the retirement plan administrator, in this case someone like Advanta, is willing to hold that type of asset. And strictly what we specialize is in holding alternatives to the traditional stock market. So anything that's not a publicly traded stock, mutual fund, ETF, things like real estate, private placements, all those kind of things are what we allow for clients to do. And it's not necessarily something that is new or bespoke. You've been able to do this since 1975 with the passing of ERISA. It's just that not a lot of custodians offer this type of asset class. And essentially, again, these things are going to be outside of the stock market, which allows you to avoid some of the roller coaster effects of the securities market at large. The securities markets are great for a lot of things, but stability in the short term, typically they can, kind of get away from that, especially with the current market situations that we're seeing. There are all sorts of outside influences that can affect it. Even things that are outside of our borders. Take, for example, the current situations in Ukraine and Israel. Those things have a direct impact on what you're seeing here in America. It's not just things like the United Auto Workers Union strike or different things that can have effects on different markets. Things outside of our borders can directly have an impact on things that are happening in publicly traded securities market. And while those things can certainly bleed over into the private market, the initial price shocks and fluctuations typically don't translate as well into those structures. Granted, it's going to be wholly dependent on the asset class and market that particular that particular company is operating in. Geopolitical things have much maybe less of a bearing on someone starting up a new brewery than they would for someone that is starting up a import-export business. So keep in mind the underlying business certainly have issues depending on what is going on in the world, just like the publicly traded securities markets do, but these things can offer a degree of insulation from that. So those are, again, some of the kind of reasons why people might choose to pursue this type of investment structure and the potential upside, being able to be an early stage investor and take advantage of investment returns that can be many multiples of your underlying basis in the investment is a very attractive option. Granted, there is a consummate amount of risk that can be assumed as well. You always hear the old adage, something like 70% of new businesses fail within the first 5 years. That is an inherent risk, but with increased risk can come potential upside to that, and that can be seen in some of the different investments that you could potentially have made into private companies once they go public or have acquisitions or other liquidity events. Why is strategy well known? The reason is economies of scale. The economies of scale for companies that sell publicly traded securities is significantly larger by an order of magnitude than what we do. It's not, again, that this is something new. You have been able to do this type of investing since the inception of IRAs, which was initially legislated in 1974, going into effect in 1975 with the passing of ERISA. So this is not something new or kind of unique to the IRA markets. You've been able to do this for a long time, but just the economies of scale between dedicated broker dealers and registered investment advisors in that market is a lot easier of a draw for people than maybe the private market is. They only want you to buy their investments. Think about it like this. If you went to lunch at McDonald's, one of the largest food chains in the entire world, they're not going to tell you that there's a small pizza shop next door. Similar kind of analogy holds true here. The IRS does allow for a very broad range of investments, but not every custodian is required to hold each one. So someone like Fidelity or Vanguard isn't required by any legal statute to allow you to invest into a private company or to buy a piece of real estate with your IRA. It's simply the fact that they specialize in something just like we specialize in it, and the market for doing this is significantly smaller. Again, a little bit of a background on maybe why you haven't heard of this, or why this has a lot more questions than maybe investing into something like a publicly traded security would be. Now, it's very important to understand what types of plans you can utilize for this, because for better or worse, there tends to be a lot of confusion around this. People, in broad terms, kind of understand the investment pretty well, but the types of accounts you can utilize and some of the procedural aspects are where people kind of get hung up on how to do this. Now, doing this type of investment through an IRA doesn't have to involve any type of tax or penalties if you're switching over from another custodian. If you've had an IRA or a Roth IRA or something like that, you're not taking a distribution to do this type of investment. Now, people erroneously get information from, let's say, broker dealers or advisors at other companies saying, hey, if you went to them and said, hey, I'd like to use my Roth IRA to invest in the startup company, they would say, you know what, we can't do that. You'd have to take a distribution, maybe pay taxes, maybe pay penalties, which is certainly not the case. It's just that they're not equipped to do this. And the other type of kind of pervasive confusion I get, and someone did ask a question to this, is that can you do a self-directed Roth IRA? Absolutely. It all depends mainly on what type of account you currently have. You don't have to do these investments through a Roth IRA or any other type of specific account. All of the accounts that are listed on the screen here, and I'll enumerate those for you here in a minute if you're just listening to this, can be utilized to invest in private equities. So to start out with, the most common is going to be your traditional IRA. The reason that the traditional IRA is the most common is that the most common type of retirement plan in the United States is pre-tax, meaning that you had gotten a deduction for adding money into a particular type of retirement plan. And the most pervasive types of retirement plans are things like 401ks, governmental 457s, 403bs, the armed service and selective service thrift savings plan. So all of these types of things are typically contributed into on a pre-tax basis. And once you terminate employment with one of those employers, you roll those funds typically into a traditional IRA, hence why they're the most popular, or I should say the most pervasive, maybe not necessarily the most popular. Another very popular option is the Roth IRA. The Roth IRA, while it is a certainly very powerful tool, it's not the only one you have to use. And most people think, well, utilizing a Roth IRA, you don't pay any taxes, it has to be the better option. Well, it's not always necessarily the case. People have reasons for using different types of plans, and a Roth IRA, while again very powerful, you do have to contribute to that plan on an after-tax basis. Or if you move from a traditional IRA into a Roth IRA, you would be paying taxes on those funds of the ones that you rolled over and did a Roth conversion of. Now that can be very significant. Retirement plans typically have a significant amount of capital in them, to the tune of the United States has roughly $27 trillion worth of retirement plan assets right now. So a lot of people having money in pre-tax plans, while yes, you certainly could move those into a Roth IRA, if you're talking about moving $100,000, $200,000 into a Roth IRA from a traditional standpoint, you would have to claim that as additional income. Now, those funds haven't had any type of tax withholding or Social Security or Medicare taken out of them. So the tax burden for doing that could be significant. And keep in mind that you're going to have to look at that from an objective point of view saying, hey, am I able to make up that difference and then also compound my earnings on top of that to say, hey, is this even a good idea for me? Or is just paying incremental taxes on any distributions at a later date the best play for me? These are all things that play into the personal decision as to which account you typically use. And more often than not, people just utilize the type of account that they currently have. So if you have a traditional IRA externally, you would open up a self-directed traditional. If you had a Roth IRA externally, you would do a Roth IRA. Not to say that people don't do Roth conversions and utilize those strategies. But again, it's definitely something to check with a CPA or an accountant on, or a tax advisor, to make sure you're acting in good faith, or at least in good financial sense to your personal taxable situation. Now, Roth IRAs and traditional IRAs, again, far and away going to be the most popular options for people. But let's say you're self-employed. You could utilize something like a SEP IRA or a simple IRA or a solo 401k to invest in private equities as well. Any type of former employer plan is going to qualify to roll over into any of these different types of buckets. Now, much less utilized, but still very powerful tools are things like health savings accounts and education savings accounts. You can utilize both of those types of plans to invest into private equity or really any type of alternative asset as well. Now, granted, the impetus for doing either of those types of plans, you really need to compare and contrast that to the present need for capital out of those, because people typically like to use health savings and education savings accounts at a little bit of a quicker pace than maybe something like a traditional IRA or a Roth IRA, where you're not going to plan to use that until you're maybe 50, 60, 70 years old. Those types of plans maybe have a little bit more of a liquidity need. So investing into something that can be as illiquid as a piece of private equity, again, it might not necessarily be the fit for everyone, but I like to make sure people understand that there are options out there for any of these types of accounts. It's not just the traditional or Roth IRA that have to be used for these types of investments. So we got a couple of questions. I think now's a good time to address those. So someone asked, may I invest my Roth IRA as in an angel fund? Yeah, that's fine. If it's a larger pooled investment fund that goes around and does angel investing to early stage startups, that's fine. We'll get into some things that you might want to consider with that, i.e., do you have a personal ownership stake in this angel fund? Is this angel fund maybe investing in your personal startup? Those are some things that you might need to look at. But on a broad sense, if it's completely arm's length, yeah, that's fine. Nothing wrong with that. We have people investing in pooled investment funds or angel funds on a fairly regular basis. And then we have a question, could Advanta IRA help deciding whether or not a certain time is a good time to do a Roth conversion, or do you only suggest I speak to a CPA? On a very high level, I'm certainly happy to have that conversation with clients, but ultimately the decision needs to come down to what you've discussed with a tax advisor. I can kind of get you through the big points of thinking, okay, here's when I'm going to receive this tax liability. Here's some high level tax strategies that you might be able to implement, but determining which one to use and ultimately making that decision absolutely has to be born from conversations with a qualified advisor or tax planner. But again, high level, I'm happy to kind of go through the basics of it with you and get you to a relatively good point to where you can take that information and not have to have, chew up your first hour of time with a tax advisor with just kind of baseline questions. So, I always encourage people, give me the call first and I can tell you what I can't answer and maybe get you through some of the basics. But again, back to this, please keep the questions coming. I'm happy to address those. I'll just kind of pick out good places to interject those. So again, plan type is agnostic of the underlying investment, but the decision as to which type of plan to use can kind of play into that, mainly with the health and education savings accounts, or health and ESA accounts are going to be a little bit more use case specific, but all the other ones are going to be a little bit longer term for most people. So any of those types of plans will work. Traditional, Roth, simple, SEP, any type of old former employer plans, solo 401ks, things like that, they all qualify to do these types of investments. Another big question that we run into is how to move funds into a self-directed IRA, because going back to that statement I made about people being, and I hesitate to use the word misinformed, but at the end of the day, it is misinformation that some people are receiving. If someone tells them, hey, you can't do this investment unless you want to pay taxes and penalties on it, you have to do it outside of an IRA. It's simply not the case. IRAs in their DNA are exactly the same, whether you hold one at Advanta, whether you hold one at Pershing, Fidelity, any of the other types of companies. And their DNA, they're all the same. The only inherent difference is going to be what that particular custodian will allow you to invest in with that plan. So again, if you switch companies, if you've switched broker dealers or switched investment advisors in the past, similar kind of situation plays out. Transfers and direct rollovers can be done at any time for any reason between these types of plans. The only time you might run into a restriction is that if you're still currently employed with an employer-sponsored plan, so let's say you still work at a company and they had a 401k and you're under 59 and a half, you might be restricted from moving funds out of that plan. But if you terminate employment or you have any of these other types of plans just sitting out there, you can certainly move them and you don't have to pay taxes and penalties to do so. IRAs transfer directly between each other without any tax reporting or any penalties. 401ks have some tax reporting, but there are no penalties. Again, there's no 10% penalty when you move between accounts. It is all done tax exempt, and it's important to understand that because that, again, where a lot of hangups I see from people, come into play is around kind of the mechanism of moving capital between types of accounts for pursuing one of these types of investments. Let's see. Before we move on, got 2 questions. How to avoid unrelated business income tax, and can I invest a self-directed IRA in my own partnership LLC? We'll get to more, we'll elucidate more on like restrictions on the personal investment partnership LLC question there in a minute, and how to avoid unrelated business income tax. That is a great question, but one that is a little hard to answer just in the context of this presentation. I did recently do a webinar on unrelated business income tax and unrelated debt finance income tax that I'd encourage you to watch if you go to our YouTube channel. It kind of dives deep into that. But there's several different strategies for avoiding that, and it really kind of depends a lot on how the business is structured from a taxation standpoint. So again, there's a lot of strategies to that, but I don't want to kind of get too far off the rails with going into that. But I do appreciate the question. Maybe give me a call afterwards and we can go through that a little bit more. So why are retirement funds a good source of capital for this? With recent bank failures, startups are looking for new sources of capital. So the need for capital in these markets, especially with the failure of things like Silicon Valley Bank, there are more people, and not to say that they are inherently couldn't find financing other places, but finding financing for any type of new business or startup can be problematic, and especially in the tech space with failures of funding sources like that, the need for capital is ever more apparent. So the ability to maybe get in on the ground floor to otherwise kind of closed off investments that were only looking for institutional money might be more available right now. So the market kind of is primed for the individual investor to get more involved in a more variety of deals. Granted, you have to take with that its own consideration of risk. If they are someone that is, needing funding from an institutional investor that was very kind of hyper-focused in a certain market, take that for what it's worth. But again, to the point of doing your homework, just because there's more deals doesn't mean there's better deals out there. Another reason that's a good source of capital. A lot of these types of investments can have very low liquidity, meaning that if you buy a piece of private stock, there's really not a readily tradable market for these things. There's not people making markets. Some of these shares might even be restricted from selling or conveying them. So if you're not looking to use IRA funds soon, having something that is a little bit of a longer term play, maybe 5, 10, 15 years down the road, granted, I would say 15 years is maybe a little bit of a unique case, maybe kind of private bank stock falls into that category. But understanding that you don't necessarily have a readily tradable market and cash flows could be slow, quarterly, annually, biannually, or non-existent until there is an inherent liquidity event. IRAs tend to lend themselves pretty well to that in most people's financial strategy because it's not something that you're looking at using in the short term. Granted, your age is going to directly play into that of saying, hey, if I'm 70 investing in a private stock, is that a good idea for me? That's something to discuss with your financial advisor and saying, hey, you know, is the inherent type of investment with the risk versus liquidity the best fit? But again, painting with a broad brush, IRA funds typically being something that you're not looking at for personal day-to-day expenses can lend itself to a more longer-term play. Looking for alternatives, another great source of capital for these types of investments. If you're looking to, again, get out of the roller coaster that can be the publicly traded securities market, these types of funds can be a great this can be a great source to help with that type of diversity and getting you into something that is inherently less fluctuating to the capacity. Granted, you also have to weigh that with the high degree of illiquidity in these types of investments and increased risk, but if that is something that is paramount of importance to you, this certainly can potentially offer that to you. And the preferred tax treatment that IRAs get. If you hit a home run and you've invested in something that, let's say, has a 2, 3, 5, 10x multiple of your underlying basis, none of that flows through to your personal income tax statement. You get to collect all of that in a tax advantaged account, and those large gains are not taxable to you, which is a great benefit to utilizing these types of plans. And granted, again, to temper all of that, you have to be understanding that these types of investments can inherently be more risky, and that also plays into who can actually do these investments as well. So some of the investment options that are out there, there are a lot of them. And just because someone's offering one thing doesn't mean it's better than the other one. It's typically going to be deal specific for what the inherent goal is of the particular investment provider. So sometimes they're looking to just sell straight equity. You're buying shares in a private company. It is just that easy. Just like you might buy common shares of Microsoft or IBM on a traded securities market, you can buy straight equity where your IRA has a direct ownership stake in the company. That is perfectly allowable and perfectly fine. But sometimes they structure these things as limited partnerships. That's a different type of legal structure. It has different tax advantages and some potential tax drawbacks depending on the underlying type of investment. Limited partnerships are very popular with things like commercial real estate, where people will put together a private offering in relation to a large piece of commercial real estate. Those are typically structured as limited partnerships. Not to say it's bad or worse than doing it as an LLC or something else, it's just typically how it's done. And again, we have plenty of clients that invest into limited partnerships with their IRA. You could buy LLC membership. Maybe it's shares of a C Corp, maybe it's an LLC, they're issuing membership and you'd like to acquire that membership with your IRA. Again, perfectly allowable. Convertible notes are kind of an interesting thing where instead of a company diluting its ownership interest, they're taking by selling equity, they're taking on debt and having it issued as a convertible note, where they could either pay the note in its entirety or, as in lieu of repayment, convert it to equity at a certain date or with a certain trigger. See plenty of people doing that. Debentures, again, are kind of a hybrid between convertible notes and just a straight loan, where you have loans to the company, maybe secured by the private stock. Again, not saying this is bad or worse, but that's an option. Syndications kind of play into limited partnerships. This is more of me just kind of making sure people understand that there's different terms for different types of investment structures. Typically, when you hear invest into a private syndication, it's going to be in reference to some type of limited partnership deal that's being put together. Syndication is basically just a broader term for a pooled investment fund, typically based around commercial real estate. You can call these things a bunch of different names, but again, syndications most often are going to be lumped in as an umbrella term for limited partnerships as they relate to commercial real estate investing. You can also invest in private hedge funds or pooled investment funds, things like that. Those are perfectly allowable. That would be kind of analogous to what the one person asked regarding can I invest into an angel fund with my IRA? And yes, you certainly can. Private hedge funds and private investment funds would kind of fall into that category. Let's see. Okay, good time to answer some questions. So we got several that have popped up. Okay. When you remove cash as a taxable event at whatever your tax rate is, correct? It all depends on the type of account. So when you remove funds from an IRA, not when there's maybe a liquidity event or a payout, because keep in mind, if you owned, let's say Coca-Cola or McDonald's, they're paying dividends, you're not taxing those dividends. They just go back into the IRA. Same kind of thing if you had some type of dividend or let's say a pref return being paid in relation to like cash flows of an underlying asset, think commercial real estate ventures are very popular with paying a pref return, then those returns go directly back into the IRA, typically non-taxable. Now, when you're talking about taking money out of the account, if it's a traditional IRA, yes, you would pay tax on whatever your current tax rate is. So if you are in a 20%, 25% tax rate and you take a $10,000 distribution, it would just go and adjust your modified adjusted gross, your MAGI, up by that $10,000 you took out. You don't have to do any basis tracking of short versus long-term gains or whatever the underlying derivative income source was. It's just as simple as saying, hey, I took out 10,000, I claim additional 10,000 of income. And again, that's for pre-tax accounts. If you had a Roth account and it's been open for 5 years and you're over the age of 50 and a half or 59 and a half, then all of it's tax-free, which again is a very nice benefit to doing that, but it's not the best fit for everyone. So just keep in mind, it's going to be determinant on the type of account you have as to what your taxation looks like when you take a distribution. When using a self-directed Roth IRA, would all the gains be truly tax-free, or are there caps on how much of private equity gains can be tax-free? That is one of the beauties of the Roth IRA. If you hit a home run with one of these types of investments, everything in that account, so long as that the account's been open for 5 years and you're over the age of 59 and a half, any distribution that you take out of that account will be wholly tax-free. Now, there are some ordering rules for how you take distributions, and again, you have to meet those requirements. But again, painting with a broad brush, account's open for 5 years, you're over 59 and a half. If you had a $100,000 investment that turned into a $3 million investment, you could take a $3 million check out of that IRA and pay a grand total of 0 in taxes, which is, again, pretty awesome. But again, Roth IRAs aren't for everyone. Not everyone has them. So again, but there is no cap. The nice thing with any IRAs, earnings are unlimited. You can make as much money as you possibly can within an IRA, and there's no limit on that. The only limits that come into play are going to be things like how much money you can contribute into an IRA. So your annual contribution limits, things like that are going to be limited, but earnings from underlying investments, not limited at all. Can you invest in a 506C private placement? Absolutely. Qualifying under the Jobs Act as a syndication under Reg D or 506C or Reg A. Those are all allowable investments. And we'll get into some of the nuance of like, you know, who you have to stay away from. They need, in general, just make sure it's arm's length. As a limited partner, as a limited partnerships, just knock out these two questions and we'll keep going. As a limited partnership, which typically wouldn't be an LLC, it'd be an LP, but I think I know what you're talking about. If you are the managing partner, can you use your self-directed IRA? The answer is kind of maybe. I would say it's a little bit more nuanced than just saying yes, you can or you can't. I do believe it's a little bit of a gray area, but I've heard differing opinions from attorneys on doing that. At the end of the day, you're safest probably not doing that, but not to say that there might be a perfectly allowable path forward. And again, it would kind of hijack the presentation to kind of go too far into that, but again, that's the high level. If a friend and I are forming an LLC to invest into a bigger venture capital, can I choose to fund my share of the capital partially with a self-directed IRA and partially self-fund while the friend funds his 50%? Yeah, you could do that. You just have to make sure it's all being done as new money and you're not kind of selling your own stake to yourself from your IRA, but there's no problem with commingling funds into like a parent venture company with your IRA and yourself personally to then plug into some type of other venture. You need to be a little bit more careful with that, but yeah. And lastly, any limitations as a managing partner in terms of ownership percentage that limits or prevents you from using a self-directed IRA? Again, there's a lot of nuance to that. If you're talking about loaning an entity money, you have to own less than 50% of the equitable shares of that company. So 49% you could potentially lend money. If you're talking about a straight equity play, I guess that kind of plays into the other person's question, is that if you have, let's say, a structure where you are the general or managing partner and you have a new stock issuance, I've seen some people say, yes, so long as that everyone's being treated equally, you're not getting any type of discount, having your IRA come in as a subsequent investor down the road, so long as it's not being given kind of like a sweetheart deal, if you will, and being able to invest while others aren't. I've seen some people say that that's allowable. I've seen people that I know and trust and that are attorneys have opinions that differ from that and say that no, that's not allowable. I kind of fall right in the middle by saying, it's something that you definitely need to check with a qualified person to determine whether or not that is an allowable investment. And I would say that it definitely falls into a bit of a gray area. Not something I would say 100% is unallowable, but check with a qualified professional to give you an opinion on it, because if the IRS ever were to examine it, I would definitely say having an opinion from a qualified attorney would be a good thing to fall back on as a point of fact. All right, moving along. Keep the questions moving on, and we'll keep going through this. So what are the benefits of drawbacks? Again, not everything is going to just be all upside. Again, with maybe the exception of hidden lottery, there are things that are going to be drawbacks. So some of the benefits of doing this with an IRA is you have a greater variety of investments you can utilize. You can invest in early stage market entry, which has a humongous potential upside if something does have an acquisition or an IPO or other type of liquidity event. You can utilize more of your own capital to invest in these types of projects, because otherwise, if you weren't using your IRAs, you would have a significantly reduced amount of capital at your discretion to invest in these kind of things. So it kind of opens up the door to more variety and more options, since you are able to do this with an IRA. And companies can find money from outside of traditional routes. So if you're on the side of raising capital, you can raise a significantly higher amount of capital from the same investor base by understanding that you can utilize IRAs as part of your strategy. Again, benefits, potential for very large returns, simplified tax filings, because none of these returns flow through to your personal income tax statement. And again, definitely some things to look at. Some concerns, and I think I need to move that last bullet point on benefits to this other column. One is that no active work on behalf of the IRA owner. Now, with private equity, that's a little bit easier to divorce yourself from, because you're not you're not directly involved in the ownership or operation of the company, unless the two individuals that asked if you could be in a managing partner situation. Again, that definitely gets to be a gray area. Some definite concerns that you have high degrees of illiquidity with this, meaning that if you buy something and you have a need for liquidity in your IRA, you can't just hit sell. You can't place a market sell order on this. There is a very reduced amount of liquidity for this. Now, I did just do a podcast yesterday with a very interesting guest from a company called Lodas Markets, LODAS, that is kind of putting together something where they are putting together kind of a marketplace for alternative assets, which I thought was pretty cool. Now, there are definitely a lot of restrictions with that, but something interesting. But again, in general, you're looking at high degrees of illiquidity. You can't just go out and sell these things. And there might even be restrictions on you doing any type of sale, even if you found someone willing to buy it. Just because there's not a market doesn't mean that you can sell this just because you want to. You have to look at the restrictions that might be baked in to investing in some types of private equity. Possible dilution of value with subsequent offerings. You have to be very aware that if you're investing very early stage and they have plans to issue more stock, then that could dilute the value of your underlying investment. Granted, you have to kind of do a lot of research with this, understand what the owners and directors of the company, what their goals and aspirations are, to kind of determine how much capital is appropriate to invest at which time. This is all going to play into investment strategy, but understanding that these companies can issue new shares kind of unilaterally. You don't have a whole lot of say. There's not, like with publicly traded stuff, there's not member voting on this kind of stuff, and there may very well be, but keep in mind that you do have the potential for companies that have to move quickly and pivot, maybe raise more capital very quickly, having to issue something that would otherwise dilute your ownership value in that particular company. And there's less regulation in this space. For better or worse, there is less regulation, there's less oversight. These types of things are not regulated by things like FINRA. They're not heavily regulated by entities like the SEC. There is some interaction with private stock offerings with making sure that they comply with the Securities Act of 1933 and are, in compliance with the exemptions specifically that they're looking to utilize. As the one individual asked, can I invest in a 506C or a 506C offering? Well, that is a specific regulation of exemption from reporting that the SEC has. So again, you're investing in something that has less degrees of oversight from the government, which some people may think is a good thing. Some people may think it's a bad thing. I think it's kind of right in the middle. There is less oversight, which can be bad, but also that allows for things to move quicker and offers a greater degree of flexibility for people raising capital. But just understand that can definitely be something you need to tack into the risk column of making sure you do your due diligence and are understandably investing with two eyes open and both feet forward in this. And unfortunately, investment losses in an IRA did not carry over to you personally. So again, playing back into that risk factor of failure in startup companies, if your IRA takes a loss in this, the IRA is not filing a tax return typically. You can't claim that as a loss. If your IRA loses money, that's just the way it is. If something goes down and you sell it or you have a loss of your underlying investment, then you're kind of out of luck. And that's why most of these investments are only going to be open to what are called accredited investors. You have to qualify to be an investor in these types of things. Now, your accreditation status does carry over to your IRA. So if you are an accredited investor personally, your IRA can invest as an accredited investor. You don't have to have over $1 million of assets in an IRA. I've seen people that qualify for accredited investor status and they only have $100,000 in an IRA, which is fine. Again, your personal accreditation for these types of investments carries over to your retirement plan. So just keep that in mind. If you are an accredited investor and looking to do this, you do have that carryover capacity for it. And I've stuck up there what the accreditation standards currently are. But more specifically, you really need to be aware of what the prohibited transaction rules are in relation to this, which are transactions between you and a disqualified person. So a lot of people, especially when they think of kind of friends and family, really there is no friends and family provision of the 504 or 506 D and C of the Jobs Act for exemptions. You need to qualify for this stuff if you're soliciting investments. Again, it's a little bit of a misnomer, but just keep in mind that you need to be aware of some of these things. But a disqualified person is anyone that is a direct lineal descendant or ascendant of you. So think mother, father, son, daughter, spouse are people that you cannot directly buy and sell things to. Now, granted, there might be some opportunities if these people are putting together fully regulated offerings and are, doing the stuff through the proper channels and treating it equally kind of similar to the gray area of investing in your own syndication as a limited partner. If you are the general partner or managing partner of an entity, there might be some paths forward for this, but keep in mind that you cannot buy or sell anything to these individuals, meaning that if you own private stock personally in an entity, you couldn't sell that to your daughter's IRA. Or if your spouse had private stock in their IRA, you couldn't sell it or vice versa. Those are some things to keep in mind, is that in general, the way to stay safe with IRAs, and again, always making sure you do your due diligence and understanding the rules, is that if you can stay at arm's length from the transaction, the better. The more arm's length, the more insular you can make yourself from the actual underlying investments, typically the better off you're going to be. But again, I can't give tax or legal advice. That's just a very broad kind of safety catch-all. Arm's length is kind of the name of the game with this stuff. And again, certain exemptions can apply. Now, regulations, most offerings after the friends and family, which again are not when you're actively opening, soliciting for new funds, are going to fall under or need to be compliant with rules 504 and 506 under Regulation D of the Jobs Act, which is a real fancy way of saying these are good questions to kind of ask. You don't need to be a scholarly expert in these particular exemptions under the Jobs Act, but just keep in mind that there are regulations that do apply to how these people raise capital. And if you're looking at something and they're not doing it correctly, not to say they're not doing everything incorrectly, but again, it's just good to understand that there are some regulations out there that govern how these types of entities and structures can raise capital and solicit for new investors. If you're looking to look for more about the offering of a company, you can go to the SEC's EDGAR website. and check it out. That's where they have the listings of people that have applied for exemptions on that. If you want to make sure that they are properly filing, it's kind of a good place to start. Also, just asking the sponsors questions. If you're going to be giving them a significant portion of capital, their ability to accurately answer questions is probably pretty paramount in your decision making. Won't spend too much on this slide. This is just kind of a picture of the people you cannot directly buy and sell stuff to. And in some instances, if they are putting together a new private offering, utilizing your IRA for investing in that could potentially be problematic. Notice how brothers, sisters, aunts, uncles, and once removed family relations are not on there. That is because they are not disqualified individuals. So if your brother is putting together a new stock offering or your sister's raising another round of capital for her startup, your IRA can absolutely invest in those. Just keep in mind is that with these things being very risky, you run the risk of having some potential very awkward Thanksgiving dinners. So just keep that in mind. Investing at arm's length is good for many aspects of this, but again, it is your burden to bear as to how much risk or how closely related to your family you'd like to invest with. But those are kind of the general rules. So just keep that in mind and act accordingly. So we're going to get into two case studies. One is going to be on an insurance startup. The other one is going to be on a commercial real estate syndication. If you do have any questions, again, please make sure that you are kicking those over to me. I'm happy to address those as they come up, but we are kind of rounding third on the actual content of the presentation because, again, it's just going to be two case studies and then we'll be wrapping this up. All right. So in this scenario, investing in private stock. Larry has a rollover IRA from a previous job and is then looking to invest part of the $250,000 balance. He's business acquaintance with Mike, who's part of a team forming a new private insurance company. Insurance company is looking to raise capital and issue stock and to get their company off the ground. So again, kind of a tale as old as time when it comes to people getting business off the ground. You have a great idea and you need capital to start getting that thing moving. And how do you do that? Well, you have to offer some type of investment. It's not just goodwill that carries these things. You want to offer a benefit to the people giving you money. And in this case, they're looking to issue private stock in the insurance company. So who does what? And again, I like to put these, I'm not oversimplifying these things for the simplicity's sake. It's just really not that complicated from the administrative side on doing these types of investments. Granted, understanding whether it's a good fit and the business operations and making sure that you're comfortable with it is where probably the lion's share of your research should go. The actual function of doing this is very simple. So who does what? Larry, in this case, the individual looking to invest part of his old 401k, first he needs to open an Advanta IRA account. We then request the $100,000 from the old plan to be moved over. He needs to review the investment prospectus for the new company, and he decides to purchase $100,000 of shares at $1 per share. He reviews and approves all the documents, and at that point, we're pretty much queued up to go. So what did we do in this process? We open the account, submit the transfer request to Larry's other IRA custodian. We ensure proper titling on the stock subscription agreement. So the PPM, which is the private placement memorandum, the subscription agreement, anything else that goes and has to be signed by the actual investor. And granted, PPMs are more of just a notification. They don't always need a signature. But in general, any investor docs that need to be signed, we have to sign and review. So we go through all that, make sure everything is copacetic with having the IRAs titled and everything done correctly. We sign the subscription documents for the IRA, and then we wire the funds for the stock purchase. And at that point, we just hold the stock certificates kind of in perpetuity until something happens. So with private equities, nothing happens until it happens, which is big oversimplification, but it's also a relatively accurate statement. There's really not much that goes on until something happens. And namely, that's either going to be a liquidity event, meaning that the company is bought out by someone, or an IPO where the company goes public and those shares are then in turn unrestricted and you can sell them and create your own liquidity event, or just continue to hold them and hope for a significant appreciation in the cost basis of the actual underlying shares. But in this case, Larry holds the private stock within his IRA. Mike and his team position the company after a few years to have the company go public. Awesome. As the company goes public 3 years later, the shares begin trading at $2 a share. So great. So he's already doubled his money, at least on paper. He works with his account manager over here to get the shares pulled over to a broker dealer. And after the IPO, there's been a little bit more appreciation. He sells at $225 a share, returning $225,000 to his IRA tax-free. Again, the strategy in this is very simple. The process for doing it is equally as simple. And the numbers and the metrics that you can kind of look at for this, again, to round it off, are simple. It's understanding whether or not this is a good fit for you and a proper kind of allocation of your capital in the regards to what you're looking to accomplish with your investments that you need to spend probably the most time looking at. Everything else with it is basically buy low, sell high, which is nice, but again, it's something that definitely needs to be kind of looked at and understood. Let's see, got a question before we go over to the next one. If a stock goes public, how do we deal with that in the Advanta account once they are public? How do you move the shares over to a traditional brokerage account? That's a very good question, and it's also pretty easy. So what happens is that if you have another brokerage account, let's say you have an external account at Charles Schwab, right? And the company goes public. The basic structure for how this works is that the company will, after they've done all their underwriting, they're positioning themselves to be listed on a public exchange, they'll have to employ what's called a stock transfer agent. And that stock transfer agent is employed to collect all the outstanding paper shares or the book entry shares and make sure what the company shows as outstanding is actually held by the individual investors. So so they correlate everything that needs to be done. They collect all of those shares. If they're paper shares, you got to mail them in. And at that point, they will convert those outstanding shares into listed shares for the IPO. And they hold them temporarily at the exchange agent or the stock transfer agent. At that point, you would tell your Schwab representative to do what's called a DTC pull, I believe is the acronym. And basically they just sweep those shares out of the transfer agent. And then at the point that they hit the, they ring the bell on the New York Stock Exchange, you can do whatever you need to with them, sell, hold, whatever you'd like to do. It's not a terribly complex process. I know if you've never gone through it, it sounds kind of complex, but at the end of the day, the transfer agent correlates all the shares. They're held at the transfer agent, and then your other broker just pulls them into a brokerage account. You can do what you want to with them. Tax-free. No, I did choose the words specifically there saying tax-free. The return on all that capital is inherently absolutely tax-free. The IRA pays no tax at that point. The only time that you would need to pay taxes is on when you take a distribution. IRAs, whether they're Roth or traditional, enjoy the tax benefit of not having to pay any tax on investment returns. The taxation, whether it's deferred or completely exempt, only comes into play once you have taken a distribution from the account. So in the life cycle of an investment for a particular IRA, if you had a 2.25x return on your initial capital, that's return tax-free to the IRA. You can turn right back around and invest that into another investment vehicle, continue to do that and compound those returns, not paying any taxes in that life cycle. Granted, yes, you are correct. When you take a distribution, that is going to be when you potentially have taxation on that distribution. So tax deferred or tax exempt does come into play in that. But I like to kind of illustrate the fact that the return at the time of receipt is not taxable. But again, it's all kind of dependent on the framing that you're looking on how I'm answering that question. So there definitely is some truth to. Let's see. Would you be able to sell some of the stock during the IPO if that is available? Well, yeah, I mean, once it goes public, it's unrestricted. You can sell to your heart's content if you'd like to. Depending on what the lockups are, there might be some additional restrictions that restrict certain classifications of shares, definitely. But that's all going to kind of come down to what you actually bought and what lockups are, applied to it. So to say that everything can be sold or only parts of it can be sold is hard for me to say because it's going to depend on the classifications of shares that are held within the retirement plan. So you just need to check with the subscription agreement and the transfer agent to that effect. On a pre-IPO private stock in a traditional IRA, but wants to move into a Roth IRA, how do I get acceptable valuation of the shares for the IRS reporting purposes? So if you'd like to do a Roth conversion of private stock from traditional to Roth, how do you do that? It's a tough question to answer. You're going to have to find someone that is willing to provide you a valuation. There are companies out there that specialize in private valuations of of shares. If it's currently still has an open investment, I've seen people that have had people sign off on saying, hey, look, the open investment dictates the price, and that's what inherently the pricing of this should be. The IRS would have to kind of audit you to make sure that they would need to audit you to really examine what the paperwork is, because at the end of the day, we as the custodian are going to say whether or not we will accept a certain valuation. We do require it be a clear independent third party that signs off on it. Typically, we like to see attorneys, CPAs, tax advisors sign off on valuations for these kind of things. And then we report IRS Form 1099-R with the correct code saying that there's no penalty for the conversion, and then move it over. It's not like they're getting a large amount of paperwork from us inherent to the actual conversion transaction. But again, who do you get to value it? That can be kind of tough because there's not people. There's a whole cottage industry of real estate appraisers out there that specialize in valuing real estate. There's business valuation companies out there that specialize in just valuating businesses, but valuating certain classes of shares of private companies prior to an IPO, significantly less people out there that are willing to hang their professional hat and licenses on valuing something like that. But again, we do have referrals that we can give out to you and kind of guide you on who would be potentially able to value something in that scenario. Alrighty, so that answers the questions for that. Let's move over to investing into a real estate syndication, because this, I would say, between private stock of just a type of company, whether that be tech or XYZ company, that is kind of half of the picture of what people invest in with private equity. The other half, or maybe even a little bit more, are people that want to invest in commercial real estate syndications, because these are going to be structured as private stock offerings. Now, in this case, you're going to be subscribing as a limited partner to a larger syndicated real estate deal, where you have general partners, which are kind of, think about like the managing members, president, CEO, operational active investors, and then you have the passive investors, which are going to be your limited partners, which in this case is where your IRA would plug in. So how does this work? So Jane and Daniel. Jane has over 100 grand in an IRA with Vanguard. She meets Daniel, who has a private offering to purchase and remodel an apartment complex. Daniel provides Jane with a copy of all of the investment documents, so prospectus, subscription agreement, PPM, everything that she needs to make her decision. She decides she wants to move forward with it. She completes the transfer request. 100 grand's moved over from Vanguard to Advanta, and then we notify her when the funds arrive. So what's the investment process look like? It's almost exactly the same as you're looking at with a traditional private stock purchase, that the IRA is going to be the named investor, the tax identification number and everything for the IRA is listed on the actual investment form. So any type of returns that are being paid out in this kind of scenario, typically you will have some type of quarterly, annual, biannual payout that is going to be based on the performance of the actual investment, in this case, a piece of real estate, rent rolls. So you do have income coming back in that's not reported to you personally. So everything is funded, and in this case going forward, quarterly distributions of $2K or $8,000 a year sent directly back to the IRA, and those types of gains are not included on Jane's personal income tax statement. Just like a dividend from Coca-Cola or McDonald's is not included to your income tax statement if you hold it within an IRA at a brokerage, same contract holds true here. So with that said, we're pretty much wrapped up. If you are looking to learn more, we do have a lot of great webinars. We also host a podcast that's released every Wednesday. If you would like to look out there to try to raise some capital or find somewhere to invest, we do hold a monthly pitch call. It's called Pitch, Promote, and Prosper. It's the last Friday of each month, 12 to 1:30 Eastern time. If you'd like to come on, we'd encourage you to get involved with that. It's free to register. If you'd like to, you can go to it, do it directly on our website. With that said, open it up to any questions if you have them. I do appreciate everyone taking your time out of your day. It's the one asset we can't make any more of, so taking time to spend it with us is always appreciated. If you have any questions that you'd like or need to elucidate on anything additionally, please let me know. I'll stick around for a few more minutes while we still have people signed in. But with that said, thanks for joining.